This is David Harvey, and you're listening to the Anti-Capitalist Chronicles, a podcast that looks at capitalism through a Marxist lens. This podcast is made possible by Democracy at Work. In the last session, I talked about the way in which surplus capacity and surplus labor was being mopped up by two unproductive forms of investment. And the first unproductive form was military expenditures, and the second unproductive form is what I would call mindless urbanization. Now, I want to take the last section and talk further about that, but my big piece of evidence on this is, of course, the urbanization of China, particularly since the crisis of 2007-2008. Now, what in effect happened was that China lost a lot of its employment in the consumer goods industries, which it was marketing to the United States. And so it found itself with about 30 million people unemployed. But within a year, it had switched so that it only ended up with about 3 million unemployed by actually a vast program of urbanization and infrastructural development. Now, whether or not that's going to be useful in terms of the productivity of the Chinese economy, we don't know. Historical evidence would suggest that sometimes vast investments of that kind do affect the productivity of the economy as a whole. I would take the interstate highway system in the United States in the 1960s as a prime example, where I think there's no question that it improved the productivity of the US economy. I think the Chinese investments in transport and communications have also likely to have improved the productivity of their economy. But then a lot of what goes on in urbanization in China is wasteful, irrelevant, and actually incredibly boring. I mean, I've stayed in some hotels that are, China's a crowded country, but these hotels are palaces, huge open spaces, nothing going on, incredible sorts of materials being used and so on, and it's kind of soulless, ridiculous kind of form of urbanization. But so that is going. So there's an example. And you see, when you say to Marx, what do you think of when you're thinking of fixed capital? And he say the machine technology, machine technical system. Nowadays, I think, what do I think of in terms of fixed capital and consumption fund? I think of the skylines of Shanghai and Dubai and New York City, and look, everything that's going on there. And I'm saying, this is the way in which surplus value and surplus productive capacity is being absorbed. So that's one part of the story. I'm now going to add another, which is that the situation in the 1980s was clearly that there were problems going to emerge in consumption and consumerism. And what had to happen was that something clearly wasn't required in terms of what Marx talked about when he's talking about the turnover time of capital. Because capital is moving. But as it moves, it has to move at a certain speed. And the speed is fixed by the turnover time. And accelerating the turnover time is one of the ways in which you absorb extra product, but also you produce extra product. So that turnover time starts to become very, very significant. And the turnover time can be broken down into two parts. One is the turnover time which is going on in the production process itself. Now, sometimes there's a long turnover time. For instance, if you're growing a crop, it's going to take you a year. If you're making ice cream, you can make it on a daily basis. So there's different turnover times. And those turnover times create all kinds of problems for financing and the like. But there is an interest in accelerating those turnover times. And that acceleration goes on in all sorts of ways. Can we make something happen quicker? Can we move quicker? Can we move over space quicker? Can we get goods faster to market? All kinds of things like that. So there's a tremendous kind of pressure of capital to accelerate turnover time. And this goes on everywhere. I mean, it used to be that hogs would have a litter once a year. They now have about 2 litters, or maybe even 3 litters a year. So you kind of you accelerate everything. And right from the 19th century, when there were all these experiments with the fermentation and so on, accelerating natural processes became part parcel of this process of turnover time. So turnover time is very important. And Marx kind of says, well, okay, there's turnover time in production, there's turnover time in circulation. That is, how long does something stay on the market before it finds a buyer? And we want to shorten that if we possibly can, because if you don't have motion, then value is lost. And as Marx puts it, we don't get devaluation because a thing cannot be sold. We get devaluation because a thing cannot be sold in time. So the question of time becomes significant. And Marx makes the comment that circulation time should be reduced to zero, if possible. And that is something which we'll come back to. But there is something else that Marx did not talk about, which I think is very important to understand qualities of daily life that we live now. And that is that the consumer time has to be zero. That is, if we have accelerating turnover times in production and accelerating turnover times in the market, and the good comes to us, then we need to use it up very fast, because if we're satiated and don't want anything more to do, the market disappears. So it's very important that goods are produced which disappear instantaneously. Now, there are a number of ways in which this can be done. One is by building such goods which are so shoddy and so bad that they fall apart, within about 10 days. So there's all sorts of strategies of that kind. There's planned obsolescence and so on, and the like. But there's a form of consumption which is which is instantaneous turnover time. And that is anything experiential, anything spectacular. Instantaneous consumerism becomes absolutely part and parcel of what consumption is going to be about. Now, by instantaneous consumerism, I mean just simply the experience. The obvious example of it is tourism. You offer an experience. It's consumed. You go home afterwards, it's gone. So it's not as if you take it home with you and you may have some photos and you may look at your photos in your old age or something like that, but basically it's gone. So tourism is a good example. Going out to restaurants, viewing spectacles, going to rock concerts, going to big football games, going to soccer games, going to all of these. Debord wrote about the society of the spectacle way back in 1967, but he didn't have in mind the kind of incredible way in which spectacle has been mobilized as a form of consumerism, which is instantaneous. So we have the consumerism which is built around, and then we have the Netflix kind of thing where you're consuming series and soap operas and all kinds of things. So the economy has changed because we need that fast turnover. And of course, what happened with COVID was all of that got destroyed. All of that possibility got destroyed. We couldn't go to the soccer matches anymore. We couldn't go to the NFL games. We couldn't go to the baseball games. We couldn't go to the theater. We couldn't go experience things. And when you look at the structure of the unemployment that went on, well, the unemployment hit areas like tourism, and look at that. The fixed capital involved in one of those cruise liners, and it can't be used for certain periods. The fixed capital involved in all those airplanes that couldn't fly because nobody was flying anymore. All those sorts of things. So we get a good picture right now of that part of the economy which was expanding dramatically. For example, after 2008, there was this sort of problem of, how's the economy going to pick up? What kinds of jobs are going to be created in the economy? There was a very, very sort of slow recovery going on in jobs, but where were the jobs? Well, one of them was, for example, the expansion of tourism. The data from the International Tourist Association it says something like the number of international trips in 2008 was something like 800,000. It'll by the time you get to 2018, it's something like 1.4 billion. In other words, there's been a sort of 60% increase in tourist activity from 2008 onwards. So this shows you that the way in which the economy is working towards the funding and and capital investment in forms of consumerism which are instantaneous, which is the society, the spectacle, organized spectacle. Now, a lot of money is spent on organizing that spectacle. You have that form of consumerism, but you need to build the hotels, you need to build the airlines, you need the airports, you need all the facilities for tourism, you need to build the restaurants. So the fixed capital in part of it becomes very significant too. And you can do a great deal of mindless sort of fixed capital investment in crazy kind of Disneyland structures and other sort of bizarre bits of architecture and so on, which you put around as being accoutrements of the tourist model. So here you've got a situation in which capital is being sustained in part by investment in fixed capital and investment in consumption fund. And you add on to that a form of consumerism, which requires a lot of that fixed capital to be oriented to a form of consumerism, which is about spectacle, about going to the soccer games, soccer stadiums, and all of that sort of thing. So there's an integrated notion here. The totality of a capitalist economy, as it were, is drifting towards this kind of world. Now, at this point, I would want to make the argument: to what degree does this make for a sensible economy? To what degree does this make any sense? The vast use of raw materials. Urbanization in China is huge, but of course that urbanization involves greenhouse gas emissions, it involves environmental destructions, it involves deterioration of environmental conditions and so on. So we're in an economy right now where the rules of dynamics are such that the economy can only go in that kind of direction, which seems to me to be basically rather meaningless. Now, I don't know if I think I did this way back. I mentioned one of these circumstances of the Grundrisse, where Marx talks about the way in which capital creates all kinds of possibilities through its technologies, through its possibilities, and all the rest of it. But at the same time as it does that, it does it in such a way as to produce a form of developmentalism that is vulgar, a form of developmentalism that is empty, that is hollowed out, that is meaningless. And so what we get is a form of urbanization and a form of capital accumulation operating right now, which is concentrated on creating meaningless kinds of environments, built environments, and doing it in such a way as to try to maximize the utilization of our senses in instantaneous pleasures and instantaneous turnover times of consumption habits. When Marx kind of says, look, we are all victims of abstractions. These are the abstractions which are powering this system right now. These are the abstractions which have to be confronted if we want to create an alternative kind of world. But you can't do it all of the time. You don't recognize that this is what is happening. This is why I get back to this notion of repressive tolerance. What is it that we can talk about and what is it that we cannot? For instance, conventional economists will not be able to talk about these sorts of questions. When Krugman kind of said in 2008, the people lacked the ability to understand what was going on, there was this wonderful moment which I always recall and I often refer to, when Queen Elizabeth, bless her soul, was sitting down with a bunch of economists from the British Association, and said to them, how come you economists didn't see this thing happening and didn't predict this thing? And the economists were shocked that somebody would ask them such a question, but because it was a question that I would ask, but nobody would take any notice, but because Her Majesty asked it, they decided to have a committee to have a look at what's going on, and they produced a report for her. And the report said, well, we missed something. What we missed was systemic risk. You think to yourself, you have a whole discipline and you miss systemic risk. This is crazy. I mean, when you create an airliner and you don't take any notice of any systemic risk, you get something like that Boeing catastrophe. And a lot of people are held accountable. Well, you should hold the economists accountable for the fact that they didn't know and they didn't notice what was going on because they were living with this efficient market hypothesis. Now, the efficient market hypothesis is one which says that demand and supply, equilibrium, prices, all this kind of thing, they work out in the long run, provided you leave it alone and don't interfere too much with it and you deregulate it. Right? That is the model which works extremely well, provided everybody is behaving like rational economic man. It's always man that you talk about here. So the rational economic being will behave in such a way in a market that everything works out. That was the efficient market hypothesis. But it turns out there are many areas in which that does not work. There is an area, now it's going to sound a little technical to you, but it's interesting to explore. There are areas where you get what are called backward bending supply curves. That's a big mouthful, backward bending supply curves. What that says is this, that situations arise in which when prices fall, people respond to that fall in prices not by reducing their output, but by increasing their output. Now, this is the case with any agent that is in a situation where they have to cover their fixed costs. Imagine you're a soybean farmer. You're a soybean farmer and prices are falling. You have fixed costs. You've got to cover those fixed costs, including, for example, your debt service. And your debt service might be very large. And if you don't have bake enough soybeans to cover your debt service, you're going to lose your farm, foreclosure. So what you do when prices start to fall is you try and produce more soybeans because you need to meet that debt service. And the result is if all farmers start to do that, as prices fall, so they produce more and more. And as they produce more and more, so prices fall further and further. Now, economists have encountered this occasionally. They kind of say, well, this is an aberration. It just is a peculiar moment. All right? Well, it's not an aberration. In fact, a lot of economic activity is about covering one's costs and trying to get a little bit extra on the above that. And to cover the costs, you need a certain volume. And if the price goes down, then you have to up the volume. That's the simple logic of it. I tell you one of the areas where this happened very badly in the 1960s and earlier was oil-producing states. Oil-producing states typically rely for their revenues on the oil price. And as the oil price goes down, so what they do in order to cover their revenues is to jack up production. So as the oil price goes down, production goes up. And that means the price goes down even further. Well, that's great for consumers. And this was what the sort of thing that OPEC formed to deal with. They kind of said, well, if this goes too far, we as producers get screwed. The benefits all go to the consumers. So OPEC forms and they start to say that we've got to regulate what we do in terms of the output. We have output targets and the price has to take care of itself. We try to stabilize the price in a certain kind of way. And of course, in 1973, OPEC did a number because of the war and everything, and that created all sorts of problems in the economy, which we went over last time. But the point here is that oil states typically operate with a very strong temptation to use the backward bending supply curve kind of mechanism. Now, here's the thing. Marx actually, his view is that the economy as a whole is entirely working on a backward sloping supply curve. And that goes back to the issue I was mentioning at the beginning of last time, which is how do we explain a situation in which the share of labor in national product is going down and the total labor force is rising? Well, the economy is being stabilized, in effect, by the economy as a whole working along a backward bending supply curve. The capitalist does not behave in such a way as to simply reduce the labor when they gain with the technological change. What they do is they go for increasing the labor force that they command. But here goes the other thing. For the capitalist, a big question is, how much do you start out with? If you have a high rate of return and you've only got an investment of $1,000, what difference does it make? Whereas you can have a low rate of return on $2 billion and can gain an enormous amount. So the capitalist is very well aware that the mass is very important, and the more mass they command, the lower the profit rate can go. But you're still increasing your mass hand over fist. And here again is something that is true of the period since 1980s. In the 1980s, the idea was that free competition was going to actually really work, and free competition was going to regulate the market. Well, one of the things, again, Marx talks about is to say there's no way in which you can prevent a system based on free competition ending up in monopoly. Because, the Darwinian, system works in such a way that, you basically become larger and larger and larger. And a great premium is on increasing size. And it's interesting that the investment banks get most of their money and most of their wealth out of mergers and acquisitions. That is, the increasing centralization and concentration of capital becomes a very crucial aspect of the system, because then you're immune pretty much to falling rates of profit, because you have such a large amount going on that a small rate of profit on the huge amount you have is going to give you an even huger amount. You'll be able to buy the US government lock, stock, and barrel. You can deal in the best Congress that money can buy, as Mark Twain put it. So the mass starts to become important. And we're in a situation where the rate and the mass have a particular configuration. Yes, the rate has been coming down, but as the rate comes down, so the mass goes up, and that is perfectly consistent with the way in which we have this decreasing share of national income going to wage labor, and an increasing volume of wage labor in the world. So that's one thing. The second thing is this. It's really interesting. In order to invest in fixed capital, you need certain funding mechanisms. And the funding mechanisms are such, and I'm going to skip a lot of intermediate stages here to simply state Marx's direct conclusion, which is that the increasing degree to which you resort to fixed capital, the more you need interest-bearing capital to support that system. In other words, debt financing is crucial for interest-bearing capital to enter into the fixed capital. So when I talked about fixed capital last time, and the increasing role of fixed capital as a sink for surplus product and surplus labor, that increasing volume of fixed capital is going to rely increasingly on financing and on the circulation of interest-bearing capital. Now, here again is one of the crucial things. And it's this, that financialization of capitalism seems to have picked up pace since mid-1970s onwards. And there are all sorts of reasons why that happened. The breakdown of the Bretton Woods restraints and constraints. And therefore, international capital could move and speculate and do all those things. So that was certainly there. But the big item, which I've mentioned, was the increasing reliance upon fixed capital and consumption fund formation as ways of absorbing surplus product. And for that to go on requires that debt financing be available. So the financialization, which many people point to but don't give any reason for, what Marx in effect says is there's a good reason why finance capital enters in, why interest-bearing capital becomes significant. And the reason is quite simply because of the increasing deployment of fixed capital. And I would add consumption fund formation. I mean, think of how much financialization is going on into the mortgage market in the United States or mortgage markets worldwide. One of the big things that people promote is, of course, the development of the secondary forms of financialization. That is, you have a secondary backup, you have a depth to the mortgage market. It's not only a mortgage market, but all of the mortgages are traded on to some organization, and we have all the things that happen. But that system is liable to crisis, and it's kind of interesting. The financial system went bankrupt because in 2007, 2008, because of it getting wacko with fixed capital formation and consumption fund formation. That is, but it got out of 2007, 2008 by a massive urbanization process in China. And China did not have a very strong financial system at the time, but as urbanization picked up in China in 2000s, or actually began to pick up in the 1990s, as it did so it became more and more definite that it absolutely needed to have a strong financial system. And it was Wild West there for financing going on, with all kinds of strange mechanisms. And in the end, they had to rationalize it and create a financial system. So China now has a financial system, not because it wanted one and it desired one, because it had to have one. And it had to have one because this was the only way it could deal with fixed capital formation and consumption fund formation. Again, Marx talks interestingly about the way in which we are all victims of the abstraction. We are all governed by abstractions. And I'm trying to give you a sense of right now of where the abstractions lie. The abstractions lie in fixed capital formation and military expenditures as major sinks for surplus value and surplus capital. Those sinks are very much dependent upon the circulation of interest-bearing capital and financialization. And both of those are involved very much in accelerating the turnover time, particularly in areas like like tourism and the like. So this is the world we are in. And those abstractions, when they come together, point to a rather meaningless kind of future. And one of the things that is so astonishing about the contemporary world is, on the one hand, the technologies which exist out there are fabulous in terms of their capacities and their powers. I love to be able to go on my Alexa system and pull up any kind of music I want to hear. It's fantastic. It's fantastic. It's wonderful. And it's super. But at the same time, we have large segments of the world's population who are totally alienated, feel totally neglected, feel life is meaningless. The volume of suicides worldwide is accelerating. The malaise, the drug addictions, and all of those kinds of things are there. And I think social media is a perfect example of exactly this tension. On the one hand, it's a wonderful thing to have, and it has wonderful capacities and powers. But then you look at how it's being used and why it's being used and the way it's being used to troll people, pull people about, and to unleash all kinds of nasty kind of political memes and the like. So we live in this world, and something has to be done about the totality of this world. Because if you try to restructure some parts of it, you're not going to get anywhere. But we have to understand the nature of this totality, what it's about. And this is what it seems to me that Marx has to offer. He has to offer a way of understanding the totality of the situation and the system. And at that point, we can start to say, how do we disconnect, decouple, if you like, from this system? I want to decouple from it. If I decouple from it and I have to lose my Alexa, well, so be it. I'd give it up for a more saner world. Believe you me. This is where we are, and this is where we have to start to construct a politics of today.
Thank you for joining me today. You've been listening to David Harvey's Anti-Capitalist Chronicles, a Democracy at Work production. A special thank you to the wonderful Patreon community for supporting this project.